Healthcare practices across the country are quietly losing revenue they have already earned. The systems designed to bill for standard medical care are stalling out when processing complex claims, leaving billions of dollars trapped. This chart shows the rising trajectory of initial medical claim denials, hitting an 11.8% failure rate across the industry in 2024. To fight back against this trend, the American Hospital Association estimates the healthcare sector spent nearly $43 billion last year simply trying to overturn denials and collect payments insurers already owed for care already delivered. This is a pure infrastructure failure. Doctors are seeing the patients and providing the treatment, but the mechanisms used to collect the cash are breaking down, turning earned medical revenue into unrecoverable debt. And if standard commercial billing is struggling, workers' compensation billing is an absolute trap for the average medical practice. Unlike standard insurance or Medicare, there is no single national fee schedule for injured workers. The system fractures into 50 entirely separate state regulatory environments. Each of those states maintains its own specific CPT code combinations and strict modifier rules. A single incorrect modifier attached to a claim guarantees a denial that requires a full manual rework. The states also enforce unforgiving deadlines. Miss a narrow filing window, like the 90-day limit mandated in some states, and that claim is permanently closed. When you force a highly specialized, state-specific regulatory maze through a generalized commercial billing workflow, you guarantee massive financial loss. Inside the practice, the weight of this complexity falls directly onto front office and general billing staff, who are simply not equipped for it. Training a general coordinator on the nuances of multiple state fee schedules takes months. And right now, administrative turnover in medical practices is hovering around 40%. Take a look at the true cost of an in-house biller. The median base salary is around $50,000. But once you add payroll taxes, health insurance, and recruiting, the fully loaded cost lands between $55,000 and $75,000 a year. Then that biller leaves. They take the institutional knowledge they memorized with them, the specific payer quirks, the carrier contacts, the unique modifier rules, forcing the practice to start the expensive training cycle from zero. Relying on this standard staffing model means a practice is paying a massive premium to maintain an incredibly fragile, high-turnover system. Because staff are stretched thin, a secondary leak forms. Workers' comp carriers frequently apply incorrect fee schedules, but the practice lacks the dedicated hours to chase down the payer portals and follow up on the phones. The result, practices silently accept underpayments on 7 to 15% of paid claims because they lack capacity to appeal. On a $2 million collection space, that translates to $300,000 of uncollected revenue every year. This money represents pure profit margin. Because the original claim is technically marked as paid, the missing balance walks out the door completely unnoticed. Stopping this leak requires a structural shift, removing workers' compensation claims from your generalist billing queue entirely and assigning them to dedicated, specialized resources. This is exactly how Staffingly solves the problem. Instead of a generic external outsourcing model, they place dedicated billing teams directly inside your practice's existing electronic medical record system. Every member of that team holds AAPC and AHIMA certifications. They arrive fully pre-equipped with the state-specific coding expertise and institutional knowledge that takes practices months to train. They also operate with a significant technological advantage. AI-augmented tools run smart routing and predictive workload management to scrub claims and flag potential denials long before they are ever submitted. This approach upgrades a practice's technical capability overnight. By catching the modifier and timeline errors upstream, the denials simply stop happening. Let's run a final financial audit to compare the traditional overhead against this specialized model. This visualization compares the $55,000 to $75,000 annual risk of an in-house hire against a dedicated Staffingly seat, which runs just $399 a week. By combining credentialed experts with automated controls, that smaller investment maintains an error rate securely below 1%. Rather than spending months recruiting and onboarding, a practice can bypass the hiring cycle entirely, going fully live and integrated within 14 days with absolutely no long-term contracts. Protecting your regining from the complexities of workers' compensation billing does not require an endless cycle of hiring and retraining. It is a highly solvable mathematical decision.